G'day there. Welcome to the closing bell on the 18th of June. Wow, what a difference a week makes. The inflation figures I was talking about last week did come in hot, and what a reaction. I said last week it was a situation where you'd probably go with the figure, one of the rare instances where if the figure was low, you'd probably buy it, and if the figure was high, you'd sell. Things have really broken out to the downside, haven't they? Really, it's everything I've been discussing for months. So I really am hoping that a few of you out there have heeded my warnings about my fears that the markets were going to sell off, and have lowered your exposure and are feeling pretty good about things, that you're not getting too hurt. And tell you what, when you're in a situation where you're not getting hurt when everyone else is panicking, you are in a really powerful position to be ready to strike once a low is formed, things start bouncing back. You can pick up some stocks for pennies on the dollar. So that's all going to be coming. That's what we're going to keep an eye on over this next 6 months. But for now, we're in the phase where the big boys and girls are coming out to play and are hitting the sell button. And it really is a big washout in that mid-cap, small-cap space. And now we've got the large caps are also selling off, with rates racing higher here in Australia, kneecapping the banks, and even problems in China hurting some of our large resources as well. So there's not that much left holding us up. So I just thought I'd show you this situation and what you could expect as things now really do unravel and start doing all the things that I've been showing you over this past sort of 6 months or so. So let's jump to the charts. So looking at the S&P 500, this is the monthly chart going back a long way to 1998. And just first of all, just note the moving averages, the 10-period exponential versus the 20-period simple. That 10-period exponential, the red line, the 20-period simple, the blue line. So that's just a very simple moving average crossover system that I've got there, just to get a sense of the big long-term trends. And it's been fabulous at picking these long-term trends, hasn't it, for a long time. There's your crash, 2000 to 2003. There's the crash, 2008, 2009. And the only other time it turned down was in late 2015, but then it turned straight back up. And that was a little false signal there. And it's been uptrend ever since. And we are now at a point where that trend shift is occurring. That doesn't mean it's all going to collapse right away. We could be getting a little bit oversold in the short term, and we have these bear market rallies. But just saying, the big picture is turning down, and there could be more to come. If we're looking at this S&P 500, the way I'm analysing it is, again, looking at those major waves, that we just trace out these major waves and work out where the buy and sell zones are and the point of control. So the buy zone of the S&P down around 2,500 to 2,800, and the market's at 3,700 at the moment. So that is really where I think it can head over this next 6 months to 12 months. It may not get there in a straight line, but I think ultimately it could head down to that area, and ultimately could be great buying down there. If we end up forming a base there, you'll see the long-term trend that we've got going on here from 2009. If I was to look at it from that point of view as well, you'd say that there's going to be strong support below 3,000 in that S&P, probably from a valuation standpoint too. But that's still a long way down from where we are now, from 3,700 to 2,800, let's say. Also, we've got the point of control coming in there. That's my initial target, around that 3,500 region. And, we could be there in the next few days, now that things are really sort of selling off in a sharp way. If we look at the weekly, you'll remember last week I was saying, once we break below that 3,800 level, watch out. And boy, that's certainly been the case. It's been a sharp sell-off. You'll see that on the weekly trends there. It's hugging that 10-week exponential on the way down. That's just giving you a sense that this downtrend is pretty strong at the moment. And look, it is just the way that these things move. Is it'll create a new low, suck in a few bears, and then have the squeeze. So you can see here, we've got a new low created, sells off quite sharply, then you have a big squeeze again. And so, we're selling off, and look, it could actually just keep trending for the moment, because it is below major support levels, and there's not necessarily a lot of support around. So there is a chance that this thing does just keep going. It's certainly a setup that it's saying such, but it's not a spot where you can really start shorting, because you've just always got the fear of the short squeeze. This could go on for months and months and months, and that could be how the bear market ends, doing something like that. So it's really is tough trading conditions. You don't want to be just blindly out there shorting the market because you're bearish. You want to make sure you're doing it in good spots. But big picture is pretty dangerous. There's no doubt about that. And, where this thing bottoms out, who knows? But they're really chasing down inflation, 75 basis point rate rise. They're serious about it. Maybe they back off in 3 months, let's say, but stocks could be a hell of a lot lower in 3 months before they start backing off. And they're just only starting to lower their balance sheet, and are going to increase that in, I think, September, the amount of bonds they are allowing to roll off. And you'll see that those bonds that we've talked about so often, the US 10-year bond yield chart, I've been watching that 3.25% level, which was the highest yield for the last 10 years, and is also the lowest high in the 40-year downtrend. So that's the level above which it's saying potentially that 40-year downtrend might be finishing. And certainly the news is saying, watch out. So we did actually see a spike through that level and a big sharp move up to 3.5%. But who knows, maybe the buying is going to step in now for a bit. But it has broken out above that level, so we've got to watch that, because if they start selling the bonds again and the yields rise, let's say above that 3.5%, which is a bit of a line in the sand now, you do have to ask the question, does it cause real panic selling in those bonds as losses pile up, especially for things like risk parity funds, etc. So yes, that's now something that is on the radar. Also, US yen and the Japanese 10 years, they're at 0.26, and there's definitely serious selling going on there, and the Bank of Japan having to soak up as many as they can with printed money. How does that finish for Japan? I don't know. Does their currency really start crashing? Why would you hold those Japanese 10-year bonds at 0.25 of 1% when rates are screaming higher around the world? So yes, it'll be very interesting to see what happens in Japan. Watching the currency is one. I did tell you about the US yen when it was below, or was around 120. And I was looking at that 125 level, which was a multi-decade high. And you can see that it's blasted off through there, the US yen. So that's the yen weakening and the US dollar strengthening. That's what this chart is showing. So there's no signs of that letting up. And I think that is an area that could be pretty scary. going forward. But, I don't want to show you many other charts out there, because there's really nowhere to hide now that it is getting to this point of sort of scary capitulation. I'm not yet willing to step up and say any low is forming yet, and I could see much further downside in the US. I think the Aussie market will probably hold in there better. So if we just switch to the Aussie market, the ASX 200 has now cracked. This is something I've been discussing for months. The topping formation that we saw, you'll see nearly a year's worth of buying going on there. And I was discussing this last week. You've had a lot of buying for that year going on. And now that it's cracked, a lot of people heading for the exit who would have been buying over the past year, and not many people necessarily wanting to buy. So you've got a big expansion of supply and demand shrinking. So that's when you can get the very sharp moves to the downside. And also we've got the false break of that 2007 high, which is what I've been watching and warning you about for months. We got the monthly sell pivot 9 months ago. And look, it's been a long wait, hasn't it? But that monthly sell pivot was a great warning sign to start treading carefully. And even though it went nowhere for a long time because the banks were being held up so well, it was still giving you the indication to just be careful buying. And now we're in the phase where it's cracking beneath those lows, and we're seeing the mean reversion move. So if I'm just looking at that wave higher, I'm saying that we should head to the point of control, and that's around 6,000. That's your first major point of support where markets might find some sort of a low. And look, that could be the low for 3 months. It could try to rally from there. And then more bad news, and then it could head down to that buy zone area ultimately. So, it could end up heading all the way down there. And I think it probably would be good buying once it headed down towards that level. But that is just the situation. We are in that phase, which happens so often, but people don't seem to realize it, that markets go down as well as up. And we are just in that phase where prices are returning to the bottom of the channel, is the way I'd describe it. So if I'm looking at the linear regression of the rally since 2009, and I'm just doing a calculation to 2016. So I'm really just looking at these two waves here and making the calculation for the line of best fit, which is showing the trend. And you can see it's been fantastic at picking the highs and lows along the way, hasn't it? So that area where we were trading up there was the top of the channel of the past few decades. And now we're selling off to the bottom of the channel. So this is where more opportunities are going to be, isn't it? Down the bottom of the channel, but doesn't mean it won't overextend initially. But ultimately, that's the spot where you want to be picking stock up for the long term. But currently we're in that sell-off phase. So now is when you're sitting on your hands and hopefully not panicking out of things. If you've been listening to these videos for the last 6 months and you're feeling pretty confident to be there when the time comes, when the dust settles and things start turning back up again. All right, well, that's enough for this week. It is really unfolding as I've been telling you for months. So I guess I'd ask you, why wouldn't you be joining Pivot Trader and coming and trading with me? That would make a lot of sense because there's going to be some pretty big opportunities coming in the next 6 months. And I think I've pretty much proved that my way of looking at things is pretty good at understanding these major flows that happen in the different markets. So just check out what I do below the video. There should be a link there. And if not, go to the Fat Tail website and check it out. And I will come back with more next week. All right, cheers.